Good afternoon. This is Ken at Tortoise Capital with a review of the weekend trading reports for October 19th, 2018. The market is in sideways volatile conditions, which means that it's favorable for short-term trading only in either direction. Sharp one-day moves, but little follow-through on the swings until I think we get through the November elections and we find out if we're going to have gridlock or more of the same madness. On an annual basis with NDX 260, we're in the middle of neutral at 57 out of 100. On a 10-day, we're on the value side of neutral at 32 out of 100. In the market mosaic, we have price slightly below the 200-day moving average in red sideways. Slope of the 50 is red bearish. The strength of trend is negative with ADX 14 at 31.7. The risk index is the 30-period moving average of the VIX divided by the 10-period. That reading is at 0.755, so we are deep into risk off, meaning favoring the non-risky assets and shorter-term trading. We take that score of 0.755 and compare it to the last 5,000 trading days, and we compute the risk z-score, or the risk z. That comes in at minus 2.85 standard deviations below the long-term average. You can see a 90-day histogram of that indicator here now with the volatility. Looks like maybe the rate of change is slowing down a little bit, but still at a very extreme reading. So this favors short-term trading, and we wouldn't think about long swings really until we see that volatility begin to reverse and move into the spring. Meanwhile, blended monthly rebalancing. You see our current holdings, reevaluation on or about 1 November, and then the current leaders based on Friday's closing price. And ETF2, which quickly responded to this kind of negativity, is only exposed to 10%. Taking a look now at some of the BMR portfolios, everything except Latin America is in the red, below its 4-month moving average. Mostly the same news with the 32 ETF, with a few defensive plays like healthcare, utilities, and some commodities in the green. Dow 30 key leaders continue to lead. So Dow, Merck, and Apple had reasonable weeks while the rest of the market was suffering. Only a few in the green here. Sector spiders: healthcare and services, utilities and staples, kind of the core competencies of the market, while the rest has pulled back below its 4-month moving average. Same in ETF Max. Even the best performers are beginning to suffer here, as you see in this going into the November elections. Market health check. Slope of the 30 and the 10 are both down. The dragon has rolled over. The expansion of volatility to the downside has opened the Bollinger Band means. The MACD histogram continues to be our friend, calling this as a weakness when it went from summer to fall to winter on this date, on 9 October, and has helped us be prepared for short side volatility. So we're in the winter because the slope is down and the MACD is below the zero line. It hasn't. The next signal would be it stays winter until the spring, when this begins to hook back up and crosses over its own 5-period moving average. That would signal the spring and the potential for some gains. Now, is that possible? Certainly, because you're seeing some form of bottoming action, even though this only got back to the edge of the river and failed. So that is an implication of more downside is possible. So I will have a short side bias if it takes out Friday's close here at 275. That's an auto short for me. But meanwhile, I'll be stalking this for swings and looking for the springtime in some of the key market leaders that we've already seen. ETF regional report. We're still 10% invested, 90% cash in the asset allocation theoretical model. Only Latin America is above its 4-month moving average. You can see in staples, utilities, and healthcare in the U.S. sector spiders leading the way. Commodities and oil doing okay. Bonds and real estate doing okay. Only the Dow showing significant strength here in the U.S., but all the small caps, most of the growth and mid-caps also suffering. Latin America and Brazil countering the trend. And Asia Pacific mostly weak as well. So it's really a stock pickers, short-term traders kind of a market. And again, I think through the November elections. ETF top 30s. That's looking at like swing time frames through a slightly different lens than BMR. Consumer staples in Brazil, both emerging strength here. Healthcare and utilities remain solid. Liquidity stats for the most liquid of the ETFs. These are based on average daily dollar volume of the last 30 days, and then doing some comparative volatility. Those that are on this chart that are in the green are very liquid and very tradable on short-term trades. Shifting to the daily. Again, we've seen that one. No channelings or overreactions. Some of the 10-day max pains that may set up for some nice bumps. I'm interested in Nike because it had been very strong, and now it may be ready for a resumption. Once we get this hookup in volatility, then these become perhaps candidates for an overreaction to the downside, and then some value plays. Also, Walgreens, Bed Bath, Caterpillar. In the Dow, plenty of auto framers setting up well. Home Depot is always an interest of mine, and it shows up well on the RSI2, as well as a 7-to-1 auto framer reward to risk. Boeing and IBM have been. Boeing has been exceptionally good. The IBM weakness continues. That's like an auto short, along with DuPont, if that suffering continues from Friday. Caterpillar, although I love the company, this is one I can go in either direction on it. If it rebounds, it has a almost 4-to-1 reward to risk upside. But if it fails, that's all part of the continuing narrative of weakness in that sector and that company. So that's a candidate to go both ways, and has lots of ATR percentage, meaning it's good both intraday as well as on a swing basis. So any of those that you see highlighted in the green in this column have a lot of intraday liquidity. So that makes IBM a candidate, Home Depot a candidate, DuPont a candidate, or I should say ExxonMobil a candidate for intraday trading. The RSI2s means in the single digits that are highlighted. Those are ones that have had like a 2-day washout and may have taken out the weak hands and setting up for some potential retracement downstream. Procter & Gamble, on the other hand, with an 8% day and a 6% 10-day, may show some follow-through momentum here. Quite a huge breakout you see on the 10-day NDX. It really broke out of its range. So that becomes a candidate for the anomaly of an upside day when the market was very weak. Shifting to the ETFs, just a couple very liquid ones, Brazil and VIX. A couple RSI2s in the single digits here. Oil exploration, energy, metals, and mining. Got just a couple dojis to choose from. A solid array of favorable reward to risk ratios. I think I will be prepared for oil after suffering for a month and 10 days, should one day of turnaround. So that may be a potential. Still has reward to risk to the upside that I like. I'd be looking for more failure here in oil, though if that doesn't work, then this collapse looks like something we could pile on. Weakness in the Russell, discouraged. Elections. Looking at pinch and stretch, Procter & Gamble had a nice big bump. The VIX had a great big bump, and so we've seen that strength already. All of those are already exceptional compared to their historical position relative to the Bollinger Band mean. Most expanded pinch box, these are the ones that have had the most directional of moves and therefore wide rivers. These are all the negative stretches. So if we were looking for things that got hit the most during this sell-off period, these would be the ones. And so that becomes a candidate for two kinds of trades. Either a continuation of failure and further weakness, or that's an overreaction kind of a move, like a 12.5% fire sale in Caterpillar. That's a 3 sigma negative move. Did they suddenly become that bad? No. Great company, so I'll be looking for some value plays among these candidates once this thing turns. Only Verizon is on the pinch right now, although Walmart, Merck, and Apple all getting fairly close. Auto framers and the RLFF regression. These are all the usual suspects. A handful of squeezes. Home Depot is one that I particularly favor. That's where the closing or the range on Friday was small compared to its normal range, and so a breakout in either direction from Friday's trading range carries some good potential for a one-day pop. Inside the MACD, organized by season, the predominance of fall and winter tells you how broadly based this market has been selling off. The ones in the summer are interesting. Disney, Walmart, Merck. These are ones that are still above their zero line, and the slope of their MACD line is still positive. So that's an interesting anomaly. The strength in Pfizer, McDonald's, and Verizon and GE means that it hasn't fallen below its own zero line yet, but you can see how many are below the zero. These in the spring, Coke, Procter, and Goldman are ones that have already the slope has crossed back up like here and crossed over its 5-period moving average, but are still outside of its river. So they would be in this segment of the life cycle, if you will. So interesting, maybe early candidates for resumption. This ADX stat is just looking at the strength of trend compared to its historical strength of trend, and just looking at Pfizer since that's been on our mind. 25.7 is its average ADX over the last 500 days. The most extreme it's gotten is 53 to the upside, and the weakest it's ever had, the strongest it would have was 65. The weakest it's ever had was 7.6. The current reading is 43, so that's at a z-score of 1.3, meaning this is a stronger trend than normal, but not the strongest that we've seen. And then the one in DuPont at 2.4, extremely strong, and we know that DuPont has been weak, so that's been an extraordinary negative trend for DuPont. Again, a potential for either continuation or a rebound. So that's how I use this report, is to find the anomalies in terms of strength of trend. These ones at the bottom are the least trending, meaning they're just mucking around sideways, searching for the next directional trend. So these would be characteristics of sideways style trades. So if you're looking for the strength of trend, you want to stay near the top here and focus on those, because either the bulls or the bears have had their way lately, and it tells you who's really in charge once you look at the chart. More market mosaic weakness here. This 1, 2, 3 breakdown here below 275 would be crucial, and then 270. Then it's Katie barred the door to the downside. All of the strength of that grinding bull has been evaporated in a week. That slope of that 30 is near historical lows at 2 Z's below. You can see on a comparative basis over the last 10 years, only 1, 2, 3, 4, 5, 6, 7, 8, 9 times in the last 10 years has it gotten more than 2 sigma below the negative slope, and that's where it is right now. The last 2 times it did that, both of these became powerful swing opportunities. So when we get to this extreme, hopefully we've made some money on the downside, hedged against the negatives, and are now prepared for extraordinary moves. This tells you just how sharply that volatility spike actually hit. And again, I think this has to do with some election shenanigans, and by either measure of price volatility or standard deviation compared to price, or as well as ATR compared to price. Quite a sharp move to the upside in volatility. Since we know that can't sustain, that makes us interested in this as a potential turning point. The last couple times the 10-period slope got this bad, there were some nice rebounds, a short duration swing, not a short swing, but short duration swings. You saw this one, nice move, and this one created a nice re-entry back to the bull. So this one may have already started that little recovery. So it'll be interesting to see how it comes out of this midpoint. If it breaks out above this hump, then up we go. If it breaks down below here, then down we go. It's pretty easy to read and more pain and suffering. I think it's upside. Politically, the most likely case here is that the Republicans lose the Congress. We get caught up in more shenanigans around Kavanaugh once the Democrats lose their mind in the Senate. And you'll see gridlock for legislation, but the seeds for some more powerful economic recovery have already been laid. It'd be hard for Trump to screw it up further. And so I think in that kind of gridlock, that's always been good for the market. And a base has been put in, so there's a value premium here already. So I think the upside is the expected probability. All right, that's everything I want to cover for this weekend report. Lots of short-term targets to frame up and to take advantage of as we go into the week ahead. Keep your risk measured and your powder dry.